Hi everyone, welcome to this tutorial on taxation. In this tutorial we are going to go over the case of a subsidy. In the lecture we saw that a quantity tax would imply a deadweight loss. I am going to show that this is also the case if instead of a tax the government gives a subsidy to the producers. Then, related to the topic of tax incidence, I will go over the case where the tax is not imposed on consumers but rather on producers. Using the same demand and supply as in the lecture, I will then show that the burden of the tax will be exactly the same. Finally, I will talk about equivalent scales, a way to compare households that differ in some characteristics. For instance, how do you compare somebody living alone and earning $100,000 a year and somebody living with a partner and 2 kids, and overall the household earns $200,000 a year? First, let's look at the effect of a subsidy on consumer surplus, producer surplus, and total surplus. Is there a deadweight loss? Well, I already spoiled the result. There will be. In this first graph, we see the market equilibrium before a subsidy. The market equilibrium is located at P star Q star. The blue area corresponds to the consumer surplus, while the red area corresponds to the producer surplus. A subsidy given to a firm represents an amount of money, S, that is going to be given to the firm every time it produces 1 unit of the good. So, it will make the supply curve shift down because now the good is S dollar cheaper to produce. So the firms won't be willing to sell the good for, let's say, $10, but rather maybe $7 if they receive a subsidy of $3 per unit of the good produced. After the shift, the new equilibrium will be located at P prime Q prime. And now we're going to see the effects on the different surpluses. Well, before even getting to the next graph, we can already imagine that since a higher quantity is being sold at a lower price, consumer surplus is going to increase. We are going to look at the impact on the producer surplus as well. But you also have to factor in the government surplus. Here, the subsidy will represent a negative surplus because it is an expenditure for the government, not a revenue. So mixing both surpluses together, we get this bigger blue area for the consumer. Then for producers are going to perceive an amount not equal to P prime, but rather an amount P prime plus S. P prime is the price that consumers are going to pay, and firms are going to receive a subsidy S on top of this price P prime. Originally, they were willing to sell the good for prices along this inverse supply curve. So, the difference between the price they receive and the price they were willing to sell the good for will be the producer surplus. This producer surplus extends all the way to the quantity sold, which is Q prime. Note that there is an area here in purple where consumer surplus and producer surplus are going to overlap. For both consumers and producers, this area represents a positive surplus. So we will have to count it twice once we add up all the different surpluses. Now, For the government, paying a subsidy equal to S for each unit produced represents a big expenditure. So that will represent a negative surplus. This negative surplus will amount to the amount of the subsidy S, which can be represented between P prime plus S and P prime, and times the quantity that is being sold, Q prime. So we will end up with this rectangle. So the government expenditure is going to be this yellow rectangle. And now, adding all the surpluses, we need to be careful because a lot of areas are going to overlap. This area in the previous graph represents consumer surplus. This tiny triangle here in the previous graph represents producer surplus. Now, this area here is an expenditure for the government, so a negative surplus, but it is part of the consumer surplus. So this area is a negative surplus for the government, a positive surplus for consumers. Both areas will cancel out, so this triangle is as good as a white triangle. This triangle here represents a positive surplus for the firm and a negative surplus for the government. Again, these two areas will cancel out, so this triangle is as good as white. Finally, this area here is an expenditure for the government, so it's negative, but it is a positive area for both consumers and producers. So we have two positives and one negative. The net surplus will be one positive. Finally, there is one area that was not that represents an expenditure for the government, but which is not a positive surplus for anybody, this triangle. So if you add the three surpluses together, you get nothing here, cancels with the consumer surplus, nothing here, cancels with the producer surplus. This area is negative but is compensated by two positive areas, so the net area is a positive surplus. And finally, a negative surplus here. This area and this area are producers and consumers and producer surplus respectively. So the final effect is that this big triangle here is going to be a positive surplus. And this triangle is, incidentally, the total surplus before the subsidy. So far, we have exactly the same surplus as the market equilibrium before the subsidy. However, we now have to take into account this yellow area, which is a negative surplus. So the final effect, the final total surplus will be the orange area minus the green area. The green area will then be a deadweight loss, the difference between total surplus with the subsidy and total surplus without a subsidy. Again, the same effect as a tax, we have a deadweight loss when the government intervenes on a perfectly competitive market. Remember that subsidies and taxes are a necessary evil for the government to be able to operate redistribution. Subsidy can be a way to encourage an industry. When there are externalities, we saw that subsidies can be used to restore the efficient amount, the socially efficient amount of the good to produce or consume. Here, they are going to be used to operate redistribution, among other things. So although there is a deadweight loss, this is something that the government most of the time has to do. Now, consider the quantity tax imposed on consumers in the lecture. But instead, let's impose this tax on producers and see the impact of this tax on both the consumer and the producer surpluses. So if instead of taxing consumers, you tax producers, then the demand function is not going to shift. Rather, the supply curve is the one that is going to shift. A tax imposed on producers means that every time a firm produces 1 unit of the good, it has to pay an additional amount equal to $T to the government. So that increases the production cost of firms. Firms then will not be willing to sell the good for PS, but rather they will be willing to sell it for PS prime, where PS prime is a shifted upwards version of PS, and the vertical distance between the two curves is equal to the tax. The old equilibrium was located at P star Q star. The new equilibrium will be located at P prime S, where P prime S meets PD, where the new supply meets the demand, P prime Q prime. P prime will then be the price that consumers pay, but firms are not receiving a price P prime. They are receiving a price P prime minus the tax, because they will have to pay this tax to the government at the end of the day. The surplus of the consumer is going to be this blue area. The surplus of the producer is going to be this red area. Note that here the consumer, the demand is steeper than the supply, which means it is more inelastic than the supply. We now need to take into account the government revenue, which is going to be the yellow area here. This surplus or this revenue is equal to the amount of the tax, T, multiplied by the quantity sold after tax, Q prime. Note that again, there is going to be a deadweight loss. This surplus, in particular the upper triangle, was part of consumer surplus before the tax, and the lower triangle was part of producer surplus before the tax. The upper rectangle here was part of consumer surplus, but now it is part of the government revenue. The lower rectangle was part of the producer surplus. It is now part of the government revenue as well. And we have one piece of surplus that is not going to anybody anymore. That is going to be the deadweight loss. Now, let's look at the impact of this tax on the different surpluses. You can see that the consumer surplus has decreased more than the producer surplus has decreased. Where does that come from? This comes from the fact that the new price P prime is higher than P star, and the difference between P prime and P star is bigger than the difference between P star and P prime minus T. So compared to before, consumers are paying a higher price. The difference in the price that they pay is higher than the difference in the price that firms are going to receive. And you can see that the lower rectangle, the lower yellow rectangle, is bigger than the upper yellow rectangle is bigger than the lower yellow rectangle. Because the demand is less elastic than the supply, the price received by producers has not decreased as much as the increase in the price paid by consumers. Again, it is a very powerful result that says it doesn't matter if you tax producers or consumers. What matters is who is more elastic. The part of the market which is going to be more elastic will have a lower burden of the tax. Or, we can take it the other way, the part of the demand which is less elastic will carry a higher burden of the tax. You can compare this graph with the graph in the lecture notes. The surpluses are exactly the same, but this time the tax was imposed on producers, not consumers. Imagine now the extreme case where the demand is perfectly inelastic, so it is exactly vertical. What's going to happen is the new price will be equal to the old price plus the tax, strictly, because the quantity will not change. The quantity consumed will not change. Imagine a vertical demand curve here. In this case, consumers are going to pay the old price plus the amount of the tax, the full amount of the tax. So they will be carrying the full burden of the tax. Producers will see no change in their producer surplus because they still receive the same price as before. They sell at a higher price, but the difference between this price and the old price will be the tax they have to pay to the government. So in this case, producers will not see any impact on their profits from the tax. Now, let's go over a way to measure inequalities across households using what we call equivalent scales. If you want to measure inequalities in the income distribution, you need to compare households. An equivalent scale is a measure used to compare wealth levels across households. Households differ in their composition. That could be the number of kids they have. That could be the size of the household in general. That could be where they live, and so on. Their cost of living. For instance, compare a couple with no child earning $100,000 and a couple with one child earning $120,000. On one hand, one couple is wealthier in absolute value. $120,000 is bigger than $100,000. On the other hand, one household is composed of two people, whereas the other is composed of three people. Two adults and one child. In this case, who is the wealthiest? We need to factor in, one way or another, the cost of raising an additional person, in this case, raising a child. Equivalent scales are numbers to multiply income by in order to compare households. They change according to different estimates obtained from data. The idea is to reflect, again, the cost of living across different households with different characteristics. So let's say that we consider the income for a couple with no children to be 100. It's not a dollar, it's an index. It is our base. If a couple with no children gets the number 100, a couple with one child, what number should it get? here it's x. Should x be higher or smaller than 100? The idea here is that these two indices represent the corresponding amount of money for each couple to be equally wealthy. So, if a couple with no children gets 100, then we want to know x such that a couple with one child is as wealthy, as rich, as a couple with no children. Because the household has one more member when there is a child, x should be higher than 100. A couple without children and $100 is as wealthy as a couple with one child and $130, for instance. Raising a child is costly, so a couple with a child needs more money to be as wealthy as a couple with no child. So now imagine that x is equal to 130. Using the equivalent scale above, which of the following two couples is considered the least wealthy? Couple A has one child and earns $35,000. Couple B earns $27,000 but has no children. So here, on one hand, we have a smaller household making less money and a bigger household making more money. But is the additional money made by the bigger household enough to be considered richer or wealthier than the smaller household with less money? Well, we need to use the equivalent scale. So to compare both households, we can multiply the income of the couple with no child by 130 over 100, which is 1.3. So the idea is that a couple with no child is 1.3 times wealthier than a couple with one child. So, if you multiply 27,000 by 1.3, then you're bringing the income of the couple with no child to the level of the income of the couple with a child. And now they are comparable. We obtain a number of $35,100, which means that, according to this equivalent scale, a couple with no child making $27,000 is the same as a couple with one child making $35,100. You can also do it the other way around. You can take the couple with one child and bring it down to the level of a couple with no child. So you can divide the bigger income by 1.3 to get $26,923.08. This means that a couple with one child making $35,000 is considered as wealthy as a couple with no child making $26,923.08. Now we can compare. You either compare $35,100 with $35,000, or you compare $26,923.08 with $27,000. In the first case, the couple with no child is considered wealthier than the couple with one child, because this couple making $27,000 is the same as a couple with one child making $35,100. The other couple makes only $35,000. So we will rank the couple with no child as wealthier than the couple with one child. You can do it the other way around. You can compare $26,923.08, which is the amount of money that is equivalent to, for a couple with no child, that is equivalent to $35,000 earned by a couple with one child. So if you compare this amount with $27,000 for the couple with no child, the couple with no child again makes more money. So in either case, the household with no child is wealthier than the one with a child. Now, given that X is equal to 130, would the equivalent scale for a couple with 2 kids be higher or smaller than 160? Why 160 first of all? Because we started at 100 for a couple with no child. Then we added 30 to reflect the cost of raising a child. If we have a second child, would the equivalent scale then increase by 30 again, making it 160? Should it be more or should it be less? You can use data to estimate these equivalent scales, but intuition can already get you halfway there. Probably it would be smaller than 160. The reason is raising a second child is not as costly as raising the first child due to economies of scale. When you get your first child, you need to buy a bunch of new things: clothes, strollers, you need to accommodate a specific bed, and so on and so forth. All these things are a big cost. Once you get a second child, the second child can use some of the equipment purchased for the first child. There is no need to buy a second bed. Once the first child is old enough, the second child can use the bed that the first child used to use when he was a baby. Same with a stroller. Once you buy one stroller, you can use it on the second child as well. You don't need to buy a second stroller. Same with clothes. Once the first child is big enough, he won't be able to wear his old clothes. Those clothes can be kept and used on the second child. So raising 2 children is not twice as costly as raising 1 child. If the equivalent scale was equal to 160, that would mean that raising 2 children is the same as is equal to 2 times raising 1 child. According to estimates, it is not twice the cost of raising 1 child, but rather it is around 1.6 more costly to raise 2 children. So probably the equivalent scale would be lower than 160. You could make the same analysis with 2 children of the same sex, and versus 2 children of a different sex. If they are exactly the same sex, 2 boys or 2 girls, then you can use everything. You can use the same clothes, same bed, same equipment. If you first get a boy and then get a girl, you might have to maybe buy different clothes. Maybe, I don't know, depending on your taste, but you might want to dress your daughter differently than your son. So the equivalent scale of having 2 boys or 2 girls versus 1 boy, 1 girl would be different again. Probably the equivalent scale with 2 boys or 2 girls would be smaller than the equivalent scale for one child of each sex. Once these numbers have been found for different characteristics of the household, then we can compare households' incomes, and then finally we can proceed to, for instance, drawing the Lorenz curve or computing the Gini coefficient to look at how equal or unequal the income distribution is. Now, this equivalent scale here is used to compare households that differ in their composition, their characteristics. We could easily make another equivalent scale called a cost of living scale. That would not account for the fact that households are different in number, but they would account for the fact that housing prices vary across cities in Canada. So instead of accounting for the number of children, we would look at somebody who makes $100,000 and lives in Vancouver versus somebody who makes $100,000 and lives in Ottawa, Halifax, Toronto, or a way smaller city somewhere in the north. So consider the following equivalent scale. If the income for a household in Ottawa is 100, then the income for a household in Vancouver is 150. The idea is that one household in Vancouver needs to be 1.5 times richer than the same household in Ottawa to be considered as rich, due to the fact that housing prices are higher in Vancouver than Ottawa. Now imagine the current tax system. Every household pays a fixed percentage of their income and received a fixed government benefit. So it doesn't matter where they live, Vancouver or Ottawa, they pay a fixed percentage of their income, something like 20%. The government then is going to redistribute some of these revenues to households. They are one household in each city with the same income. Taking into account the cost of living scale suggests an alternative policy to decrease inequalities. Since both of our households make the same amount of money, the household living in Vancouver will be considered poorer because it has to spend more money in housing than Ottawa. If they pay the same amount of money in tax and receive the same amount of money from the government, then at the end of the day, the household from Vancouver will still be considered poorer than the household in Ottawa. So, the average tax rate between the two households is the same if we don't take into account the cost of living scale. The household living in Vancouver might be paying the same amount of taxes as the Ottawa one, but it is relatively poorer because of the cost of living. So a way to fix this inequality would be to either give more benefits to the Vancouver household so that the overall average tax rate is the same between the two households after taking into account the cost of living scale. So either you give more back to the household in Vancouver, or you tax the Vancouver household less in the first place. That would be a way to not impact household too much and in fact decrease inequalities. Here the inequalities are coming from the fact that these households live in different cities with different cost of living. They earn the same amount of money in the first place. Now, this is not something that governments like to do, and this is not something they do in practice. Why? Because if you give more money to the Vancouver household on the basis that Vancouver is a more expensive city, then there are going to be effects on the Vancouver market. If the government gives more money back to the Vancouver households, there is going to be a higher demand for housing in Vancouver, and housing prices in Vancouver will increase more than in Ottawa. And at the end of the day, even after receiving a better benefit, a higher benefit from the government than Ottawa households, the Vancouver households might still end up poorer because now the cost of living in Vancouver is even higher. So every time the government thinks of taxing and redistributing, it has to be aware of the general equilibrium effect. If you launch a massive redistribution campaign, then there will be a higher expenditure by households, a higher demand, which is going to lead to an increase in market prices. So it doesn't mean that households at the end of the day will be made better off, because prices could be higher and their surplus could still be the same as before or even lower. It is important to consider these parameters, these effects, when designing a policy in order to decrease inequalities. Because of all these general equilibrium effects, at the end of the day, there might be more inequalities than before the policy was implemented. So remember, governments often use taxation as a way to get revenue in order to exercise regalian functions such as justice, defense, security, maybe education and healthcare. That depends on the countries. They also need some funding to fund infrastructures and public goods, roads, parks, and so on. Finally, they use these revenues to operate redistribution. The idea is to go from one Pareto efficient allocation to a better one. In the process, somebody will be made worse off, yes, because the first allocation is Pareto efficient. But we are also going to another Pareto efficient allocation that might be preferable based on some criteria such as equality, fairness, and so on. Maybe the amount that some consumers will be better off by will offset the amount that other consumers will be made worse off by. So you might prefer a Pareto efficient allocation where you redistribute some of the tax revenue, as opposed to a Pareto efficient allocation which is less equal. Taxing and subsidizing lead to deadweight losses when markets are perfectly competitive. So they are some kind of a necessary evil. Whether you tax consumers or producers on paper doesn't have any impact in reality. At the end of the day, who carries the burden of the tax will all depend on which side of the market is more or less elastic. It might be bad for public relations to say that the government is going to tax consumers, but at the end of the day, whether they tax consumers or producers for the same good in the same amount will have the same impact on the market. Income tax systems, or tax systems in general, can be made progressive, regressive, or neutral. Remember, they are progressive if the average tax rate increases with income, regressive if the average tax rate decreases with income, and neutral if the average tax rate stays the same as income increases. Making a tax system more or less progressive will also be a way to have an impact on the income distribution and income inequalities. That's it for this tutorial on taxation. Have a good one. Bye.